Good evening, students. Hope you are well in your preparation for upcoming examination May 2024. So coming to the point, we have no idea about the paper pattern for upcoming examination of May 2024. But now ICAI has released a mock text paper. So, and for making this video is to communicate the pattern of question paper and the analysis of question paper with answers also. Okay, so this making this video is as per the instructions made by our academic director M. Prakash sir. So he instructed me to make a video immediately and make it available to all the students for the benefit of students. Okay, let's coming to the point. Analysis of MTP released by ICAI. So this is the MTP released recently, and first of all I give you overview of this MTP. Then we'll explain the analysis of each and every question. Okay, so taxation. $100 marks. Income tax 50 marks. GST 50 marks. And important point, section A income tax, section B GST. So, and one more important point, section A is having two divisions. Division A, Division B. Division A, MCQs exclusively for MCQs of 15 marks. Division B, descriptive type of questions. Okay, so division B is having 4 questions. Question number 1, 15 marks from total income chapter, which is compulsory question. Question number 2. Question number 2, having 2 sub questions. One is for 6 marks, another one is for 4 marks. A 6 marks, B 4 marks. Total 10 marks. And question number 3, also having 2 sub questions. A 5 marks, B 5 marks. Total 10 marks. And question number 4, also having 2 sub questions. A 6 marks, B 4 marks or 4 marks. Total 10 marks. And one of the important point, question number A, question number 1 is compulsory question which carries 15 marks. Out of remaining 3 questions, you will answer any 2 questions. So one choice question is there. And one more important point, in question number 4 itself, there was a choice, that is internal choice. Question number 4 part B, having 2 sub questions, you can answer any one of those questions. So answer any 2. So this is the overview of the MTP released by ICAI. Have you understood? So now coming to the point, the analysis of MTP. Question number 1. Question number 1, division A is a multiple choice questions. Division A, multiple choice questions. Total 15 marks. Out of that, first question is scenario based question, case scenario based question. So this is the case scenario, and based on this information, you will answer this following 3 MCQs. Each MCQ carries 2 marks, total 6 marks. Okay. Question number 1, scenario based question. 3 MCQs carry 2 marks each, total 6 marks. Okay. So I'll explain in brief the question number 1. Question number 1 is exclusively relating to PGBP related information, that is 35 AD, specified businesses. And this information is related to 80 JJAA, chapter 6 year deduction. Okay, based on this information, you will answer any of these, you will answer these following 3 MCQs. Each MCQ carries 2 marks. Okay, first MCQ is determine the deduction under section 35 AD. That's it. 35 AD is nothing but is available deduction at the rate of 100% of capital expenditure, either incurred before commencement of the business or after commencement of the business. But one thing we should remember here is land is not at all eligible for deduction under section 35 AD. Okay, so please verify the information given here. So here the date of commencement of 3-star hotel on 1/4/2023. Capital expenditure 50 lakhs was incurred in March 2023, is nothing but before commencement. But this expenditure is exclusively for purchase of land. Land is not at all eligible for deduction under section 35 AD. Okay. So next, and above business and capitalize the same in the books of accounts as on 1/4/2000. Further, during the previous year 23-24, he incurred capital expenditure 2 crores. It's an after commencement expenditure 2 crores. Out of that, 50 lakhs is for acquisition of land. Land is not at all eligible for deduction. So out of 2 crores, 50 lakhs shall be reduced because 50 lakhs is not eligible for deduction. The balance 150 lakhs is only eligible for deduction. So before commencement expenditure 50 lakhs exclusively for land, not eligible for deduction. After commencement expenditure, total expenditure incurred 200 lakhs, 2 crores. Out of that, cost of land involved is 50 lakhs, not eligible for deduction. Balance 150 lakhs is only eligible for deduction at the rate of 100%, is equal to 150 lakhs. This is the answer for first question. Okay, question number 2. What would be the income chargeable to tax under the head PGBP income? Here the question is compute the PGBP income. Here PGBP income given in the problem. Here the PGBP income is 85 lakhs. The profit from the business of running this hotel before claiming deduction. Here the available profit is before claiming deduction under section 35 AD. But we are required to calculate the profit after claiming deduction. That's the MCQ number 2. Okay. So I'll give you the answer. Profit before claiming deduction is equal to before claiming deduction is equal to 85 lakhs minus the deduction under section 35 AD is equal to 150 lakhs calculated above. Therefore, the resultant amount is 65 lakhs loss. And one more important point, loss from any specified business can be set off against the income from another specified business. Yes, available. It can be set off against another specified business. Here, the assessee is having another specified business, the 4-star hotel. The Kamal also has another existing business of running 4-star hotel in Ahmedabad. The resultant income from this business is 140 lakhs. You can adjust the loss of 65 lakhs against this profit. The balance is liable to pay tax to the government. That's it. So therefore, plus profit from Ahmedabad business, another specified business, Ahmedabad hotel, 140 lakhs. Therefore, ultimate the result is 75 lakhs is the net profit, PGBP. The answer is A. Have you understood? Okay. So next, question number 3. calculate the deduction under section 80JJAA. 80JJAA is a chapter 6 deduction. I give you some information about 80JJAA. 80JJAA is available to creation of employment creation. That is 30% of additional employee cost is eligible for deduction. But additional employees does not include employees working less than 240 days, and employees does not participate in RPF, and employees whose salary exceed 25,000, and all these employees are not to be considered for calculating the 80JJAA deduction. The balance employees are only eligible for deduction. So just please observe the table about the employees details. Last 20 employees, the employees regular, casual, regular. So please read this sentence. All regular employees are participate in recognized provident fund. It's nothing but casual employees does not participate in recognized provident fund. Therefore, casual employees are not eligible for deduction. Okay. And one more important point, employees working less than 240 days are also not eligible for deduction. Please observe 30 employees date of appointment is 1/9/2023. Less than 240 days employees. Therefore, these employees are also not eligible for deduction. The remaining employees are eligible for deduction under section 80JJAA. Therefore, deduction under section 80JJAA is equal to 40 employees into appointed on 1/6. Therefore, he draws salary only for 10 months. 10 months salary into 24,000. 80 employees into 9 months salary because he appointed on July 1st into 24,500. Into 30%. That's the main answer. 80JJAA. Okay. So that is the answer is 81,72,000. Please verify it. Okay. 80JJAA is an important section mainly for upcoming examination. Please verify it carefully. So some of the employees are not eligible for deduction. Okay. Next. So this is scenario based question, and the second question also case scenario. So this is the information, and below that there are 3 MCQs, carries 2 marks each, total 6 marks. So 3 MCQs. Scenario based question again. Arvind, an Indian citizen, wants to file the income tax return. Arvind owned a house property. The return filing, return of income related information, and there is a credit of income tax refund. It includes interest on income tax refund. It will be taxed under the head income from other sources. Interest on income tax refund is taxable under the head other sources, but income tax refund is not taxable. But interest portion is taxable under the head other sources, and having an income from other sources. So Mr. Arvind is having income from house property, let out of his property. Mr. Arvind owned a house property in Bangalore, and same was rented out of 65,000 per month to Mr. Arjun, a salaried employee. So income from house property. Okay, and one more information here is the last information. This is the information relating to residential status, determination of residential status. On further assessment, you were able to understand Arvind and his wife had traveled to Mauritius during the previous year 23-24 to spend some time with their son, who is staying in Mauritius. On scrutiny of their passport and relevant and returned and relevant documents, you conclude that they had left India on 27 September 2023 and returned to India on 31st March 2024. During 4 years preceding previous years, both had stayed in India 320 days. That is B2 not satisfied. Here B1, B2 both not satisfied. Therefore, it shall be treated as a non-resident. B1 not satisfied, B2 not satisfied. Please verify the information carefully. Okay. So here the Arvind's status is non-resident. Here the Arvind status is non-resident. First MCQ for 2 marks. Next one is there any requirement to deduct tax at source under section 194 IB, that is TDS from rental payment? TDS from rental payment on such rent by Mr. Arjun. Is Mr. Arjun is required to pay any rent, required to make TDS under section 194B on payment of rent to Arvind? Please verify the first paragraph. Arvind owned a house property in Bangalore and same was rented out for 60,000 per month to Mr. Arjun. Here owner is Arvind. Tenant is Mr. Arjun. Who is paid in this case? Arjun pays rent to Arvind 65,000 per month. Now the question is Arjun required to make TDS under section 194 IB? That is the second MCQ. But here one thing we should remember, please verify section 194 IB. So 194 IB, TDS shall be made only if recipient is a resident. But here the Arvind residential status is non-resident. Therefore, TDS provisions are not applicable under section 194 IB. Need not made any TDS by Arjun under section 194 IB, because here the residential status of recipient, that is Arvind, is non-resident. No, there is no requirement to deduct tax at source under section 190 since Mr. Arvind is a non-resident. Please verify the section 194 IB. Okay. Next, third one. Which of the following statements is correct with respect to the advance tax liability? Is Mr. Arvind liable to pay advance tax or not? Advance tax provision says that advance tax liability will arise only if the amount payable is more than or equal to 10,000. Otherwise, no need to pay advance tax. Yes, here Arvind's income tax compulsory exceed 10,000, because here Arvind is having two heads of incomes. One is house property, second one is other sources. If you calculate the tax liability of Arvind, compulsory it exceeds 10,000. Compulsory that Arvind is required to pay advance tax mandatorily. So that is advance tax liability shall arise since his tax liability not less than 10,000. Is nothing but more than 10,000, more than or equal to 10,000. Arvind required to pay advance tax mandatorily. So one MCQ related to residential status, another one related to TDS, TCS, third related to advance tax. It's a comprehensive information given above, that is case scenario. So the MCQs related to 3 different chapters. That's why it shows the importance of case scenario questions. So dear students, compulsory you should prepare scenario based questions in each and every chapter mandatorily. Okay, so scenario based questions very important for upcoming examination, mainly for upcoming examination under new scheme. Okay, don't neglect. Okay, next, coming to the next MCQ, MCQ number 3. It's exclusive individual MCQ. So is nothing but 10AA related MCQ, 10AA. Deduction under section 10AA. Please verify the provisions carefully relating to 10AA. 10AA is available only to the profit relating to export turnover. Profit relating to export turnover into 100% if the incorporation date is within first 5 years. In next 5 years, 50%. Okay, so that is how to decide whether he is in first 5 years or next 5 years based on the date of starting the manufacturing. Here the date of starting the manufacturing unit in special economic zone on 12/5/2014. Therefore, we are in 6 to 10 years. That is next 5 years. We are eligible only to 50% reduction of export turnover. How to calculate the export turnover? Total turnover into total profit into export turnover, export profit. 50% of deduction of export profit. How to calculate the export profit? So here, Rudra Limited total turnover of the Rudra Limited is 12 crores 50 lakhs. Rudra Limited is nothing but it's a details relating to both special economic zone and DTA, domestic tariff area related unit. Okay. Rudra Limited total turnover is 12 crores 50 lakhs. Out of that 4 crores 50 lakhs respectively. So 4 crores 50 lakhs is related to DTA. The balance is treated as turnover related to special economic zone. Okay. So turnover of CES related turnover is equal to total turnover is equal to 12.5 crores minus 4.5 crores is equal to 8 crores. And one more important information, profit export sale of special economic zone and DTA is 3 crores 50 lakhs. Export turnover is equal to export turnover 3.5 crores. But one of the important information, and 2.25 crores is related to DTA. And the net profit of CES unit and DTA is 95 lakhs. Profit is equal to 95 lakhs. Okay, 80 lakhs related to DTA. So one thing compulsory, you should remember, 10AA deduction is not available to DTA. So ignore the information relating to DTA. Okay, only information relating to special economic zone related unit is sufficient to answer this question, because 10AA is available only to CES unit, not to DTA. Okay, so CES unit related total turnover 8 crores, export turnover 3.5 crores, total profit 95 lakhs. And one more important point, out of the export turnover 3.5 crores, 2 crores have been received in convertible foreign. Amount brought to India in convertible foreign exchange is 2 crores. Only 2 crores to be considered as export turnover. There was a condition in 10AA, that is export turnover is nothing but consideration for exports either received in India or received outside India but brought into India within 6 months or such extended period. Otherwise, such turnover is not treated as an export turnover. But here actual export turnover 3.5 crores, but out of that only 2 crores were brought into India within the time limit. Therefore, 2 crores itself to be considered as an export turnover instead of 3.5 crores. That's the important information. Now calculate the deduction under section 10AA. Deduction under section 10AA is equal to total profit into 95 lakhs into export turnover divided by total turnover, 2 crores divided by 8 crores into 50%. That's the deduction. Okay. So the answer is 11,87,500. Okay. Next one. Last one is just tax liability calculation under default tax regime under section 115 BSc. Okay. So first of all, tax is equal to first 3 lakhs 0. Next 3 lakhs 5%, 15,000. Balance 1.25 lakhs into 10%, 12,500. Total 27,500 minus rebate. So one of the important amendment in Finance Act 2023. Now rebate is available under default tax regime in some cases, even if total income exceed 7 lakhs. Here rebate is equal to total tax minus income over 7 lakhs. Total tax here is 27,500 minus income over 7 lakhs is equal to 25,000 is equal to 2,500. 25,000 plus health and education 4%, 1,000, total 26,000. Okay. So these are the MCQs. Total weightage 15 marks. 2 case scenario questions carries 6 marks, 6 marks, 3 MCQs each, and 2 individual MCQs. Next, coming to the descriptive part of questions. First one is total income. Total income problem carries 15 marks. Okay, and one of the important point, I will explain the only adjustments and important adjustments. I think it's two fundamental problem. Don't worry, and very easy. All the adjustments were covered in various problems in your material. Please verify those problems where it was covered. Okay. So, and one more important, please observe the question is compute the total income and tax liability. Most beneficial method. Most beneficial method. Whenever using this sentence, you need to answer this question compulsory in both the tax regimes and suggest which tax regime is beneficial to the assessee. That is, which tax regime is having lower tax liability. Okay, most beneficial method, opt out and default, and make a conclusion which tax regime is beneficial to the assessee. That's it. Most important sentence in this problem. You must answer this question in both the tax regimes. Okay, I will explain the adjustments. First adjustment, income tax refund 4,500. Interest allowed there in income tax refund credited in P&L account. Actually, income tax refund is not taxable. Income tax refund is not taxable, but whereas it includes interest portion, interest is taxable under the head income from other sources. Income tax refund includes amount of 4,570 of interest allowed thereon. This will be taxable under the head income from other sources. Principal amount is not taxable, but interest portion is taxable under the head income from other sources. Okay. Next one. Salary includes 30,000 paid to his brother, which is unreasonable. Unreasonable expenditure made to relatives or close associates shall be disallowed. Part A, subsection 2. The simple adjustment. And advertisement expenses include 2,500. Advertisement published in souvenir issued by political party, not allowed as an expenditure. Simply disallowed. Next one, 37 2B. And the next one, miscellaneous expenses includes an amount 1 lakh paid to political party by check. It's 80 GGB or GGC. If assessee is an Indian company, GGB, otherwise GGC. Yeah. Here assessee is an individual. Therefore, 80 GGC deduction available, but 80 GGC. But this deduction is available only in opt-out, not available in default. Opt-out only. Okay. Next one, goods and service tax demand paid includes an amount of 5,300, charges penalty for delay filing the return of income, so not allowed as an expenditure. Breach of law is not at all eligible for deduction. But and also includes 12,750 towards interest for delay in deposit in tax. So this will be allowed as deduction because it's a breach of contract, is nothing but compensatory nature penalty. Compensatory nature penalties are allowed as deduction. Generally, penalties are not allowed, but compensatory in nature will be allowed as deduction. Please verify explanation 1 to section 35, 37, subsection 1. Okay. So next, breach of contract, penalty related to breach of contract eligible. Penalty related to breach of law is violation of law is not at all eligible for deduction. Next one, Amit has purchased a warehousing building 20 lakhs in rural area for the purpose of storage of agricultural products. This was made available for use from 15/7/2023 and the income from this activity is credited to the profit and loss account. It's the letting of warehouses for agricultural produce. It's a one of the specified business covered under section 35AD. Section 35AD. Of course, the income from this warehouse is also taxable under the head PGBP. No doubt, this will be also taxable under the head PGBP, but it's a specified business under section 35AD. Okay. So, and the income from activities credited to the profit and loss account. The income from this warehouse was credited already in P&L account. Warehousing charges. So taxable as PGBP income. Next, depreciation. Depreciation under Income Tax Act 1961 works out 65,000. But amount debited in P&L account is 1,07,250. So cancel this amount and allowed the depreciation according to the Income Tax Act, including the warehouse related deduction also. So add the warehouse related deduction and claim as new expenditure of depreciation. 65,000 plus warehouse related deduction, because warehouse is also an expenditure. Next, interest on loans include an amount of 80,000 paid to Mr. Mohit, a resident, on which tax has not been deducted. Therefore, this will not be allowed as deduction. 30% is allowed because paid to Mohit, resident. 30% is allowed. That is section 40A 1A. Okay, so these are the adjustments relating to total income, and all the adjustments are very easy except warehousing point is something new. Please verify it carefully. And one more important point, penalties point is also very important. And the main observation in this problem is the problem will have solved in two tax regimes, compulsory in both the tax regimes, opt out and default. That is the something new in this problem. And one more important point here, 35AD deduction is also involved, 35AD business involved in this problem. Therefore, you need to apply AMT provisions also. Need to check whether he is liable to pay AMT or not. That's also one of the important observation in this question. Need to calculate AMT and check whether he is liable to pay AMT or not. That's the another important observation. But concept of AMT is applicable only in opt-out tax regime. In default tax regime, the concept of AMT is not applicable because 35AD deduction is not available in default tax regime. Only opt-out tax regime it will be allowed as deduction. Okay, important point. And one more important point here, this is the answer for question number 1. As per section 115 BAC, default tax regime, the answer is 50 lakhs 38,620. Whenever answer just exceed 50 lakhs, just 38,680. Therefore, you need to pay surcharge at the rate of 10%. Whenever applicability of surcharge, mainly then is in this case is required to check whether marginal relief is available or not. That's also another important observation. Check about the marginal relief. Is it available or not? So adjustments point of view very easy, but the problem complication is the problem will be solved in various versions: default, opt out, AMT, and verification of marginal relief. That's why the problem is very complicated and lengthy. So my dear students, my suggestion is better to prepare this problem mandatorily. Okay, so the way of presentation is very important, mainly for total income problem. Okay. Question number 2 is purely the residential status problem. Residential status. So determination of residential status, and it's mainly exception 2. Indian citizen or person of an Indian origin settled outside India visit India during the current previous year. Based on the information, answer this question. Determine the residential status. Okay. So here Akash is an Indian citizen, age 45 years, worked in XYZ Limited in Delhi. He got a job offer from ABC Incorporation, California on 1/6/2022. He left India for the first time on 31st December. So, and he got a job offer from ABC Limited, California on 1/6/2022. He left India for the first time on 31st/7/22 and joined ABC Limited on 8/8/2022. During the previous year, 8/8/2022, joined in a job in 8/8/2022 is nothing but last year, that is 22-23. Is nothing but he settled. Now he settled outside India since last year. But what is the status in current previous year? During the current previous year, Mr. Akash visited India on 25/5/2021 to 22/9/2022. So based on this information, first to determine his residential status. He was covered in exception 2. Exception 2. Indian citizen settled outside India since last year. Now during the current previous year, he visited to India. And exception 2 having two parts. Part 1 is if total income other than income from foreign sources, if it exceed 15 lakhs, if it does not exceed 15 lakhs. Now please check whether the total income from total income other than the foreign sources exceed 15 lakhs or not. For that, he given an information about the details of total income. Salary from ABC Limited, California, received in California. No doubt it's a foreign source of income, not to be considered. Next, dividends from Indian company. It's an Indian source of income to be considered. Agricultural income from land situated in Nepal, received in Nepal. It's a foreign source of income, not to be considered. Rent received from house property in Delhi, Indian source of income, but taxable value is 70%. Standard deduction is there. 5.5 lakhs into 70%. So it's nothing but 3,85,000. Past profit from a foreign profession in California, which was set up in India, received that. It's an Indian source of income. So here the Indian source of income is 5 lakhs plus 3,85,000 plus 6 lakhs. Total 14.5 lakhs. Therefore not exceed 15 lakhs. Therefore he was covered in exception to Part A. Part A, what is the requirement? What is the condition to be applied here is only B1 to be satisfied to get the status of resident. If B1 was not satisfied, then he shall be treated as non-resident. Exception to Part A applicable here because his total income other than the foreign sources does not exceed 15 lakhs. Okay. Next one. Examine and compute the total income for the deduction of tax at source, TDS. TDS related questions. Point number 1. State Bank of India pays 70,000 per month and 60,000 per month as rent to central government and rent to Kunal. State Bank of India paid rent to two parties. One is central government, second one is Kunal. Respectively for building in the branches in which its branches are situated. Okay, what will be the TDS consequences? Here the payer is State Bank of India. Payee is case 1 central government, case 2 Mr. Kunal. So here one of the important point here is 194I TDS on rental amount. So 194I, there is an exception in section 196. If payment made to central state governments, the payer is not required to make any TDS on such payment. It's an exception. Central government, if recipient is central government, then payer need not made any TDS as per section 196. Therefore, rent to central government is not subject to TDS, section number 196. But rent to Mr. Kunal is subject to TDS, compulsory, because the payment exceed threshold limit under section 194I. Okay. And the next one, rent to State Bank of India, paid rent to two parties, central government, Mr. Kunal. Rent to State Government of India is not subject to TDS. It's an exception to TDS under section 196. But here required to make TDS mandatory. Okay. Next one. Payment 2,50,000 to Mr. Deepak, a transporter who owns 8 goods carriages, is related to 194C. 194C, there is an exception. There is an exception, that is, if transport operator, if assessees, business of the assessee is transport business and having not more than 10 vehicles at any time during the previous year, and he furnished his PAN number to the payer. If these three conditions were satisfied, then TDS not required for such payment. That's an exception to section 194C. There are three conditions in that exception. One is the business is transport business. Second one is the vehicles does not exceed 10 at any time during the previous year. Third condition is furnish his PAN number to payer. If these three conditions were satisfied, then TDS not required on such payment. But here, payment 2,50,000 to Mr. Deepak, a transport operator, one of the condition was satisfied. And vehicles, owns 8 vehicles, 8 goods carriages. Yes, another condition was satisfied, less than 10 vehicles. But the third condition is he does not furnish his PAN number. Third condition failed. Therefore, here exception is not available. They need to make TDS. TDS applicable under section 194C. Exception not available. Exception not available. Therefore, required to make TDS under section 194C. And one more important point here is TDS rate is 20% because reason is he does not furnish his PAN number to the payer. Therefore, section 206 CAA gets attracted. Then higher TDS applicable at the rate of 20% instead of rate specified in the Act. Okay. Have you understood? Next, question number 3. Mr. Sahil, a resident individual, 40 years, is the assistant manager of Fox Limited, getting a salary of 55,000 per month. Registered salary head. So it's for two fundamental problem from salary set down. Basic salary 55,000 per month, fully taxable. Dearness allowance 10% of basic salary, fully taxable. Bonus fully taxable. Medical allowance fully taxable. So he was also reimbursed the medical bills of his mother dependent on him, amount to 6,500. And he shall provided a laptop not taxable. Laptop and computer provided by the employer to employee for uses, irrespective whether personal or office, nothing will be taxable. Okay. So here laptop was provided, not taxable. Next one, domestic servant monthly salary of taxable per visit. Okay, almost all the benefits are taxable except laptop and laptop facility is not taxable. Next, in addition that fat equity shares. Fat equity shares is also another perquisite. Number of shares allotted 700 equity shares. Issue price 170, market price 280. Taxable value is 280 minus 170 into number of shares. Paid market value on the date of exercise the option minus rate charged by employer. So 280 minus 170 into number of shares. That is the taxable value. Laptop facility is not taxable. Next, market value. So professional tax 2,200. Professional tax 2,200. Out of that 1,400 was paid by the employer. Whenever the payment was made by the employer, first included in the income. Then only to be claimed as deduction. Included in income. Then claimed as section 16 deduction, professional tax. Okay. And one more important point is compute the total income under the head salary of Mr. Sahil for the assessment year 24-25 if he is paying tax under default tax regime. Answer this question under default tax regime. What will be the consequence in default tax regime? Here is Section 16 deductions. Section 16 deductions, standard deduction is available now in both opt-out as well as default. But professional tax is not available in default tax regime, but only available in opt-out tax regime. But here we should answer this question in default tax regime. Therefore, a professional tax is not to be claimed as deduction, no deduction under Section 16, under default tax. I think it's a two fundamental problem. There is no complication in this. Next one is, Kunal is a resident but not ordinarily resident in India. Resident but not ordinarily resident, RNOR. So during the assessment year 24-25, he furnished the following information regarding his income and expenditure pertaining to the house property for the previous year 23-24. He owns two houses. One of the house in New York house. One of the house in New York and the other in Ahmedabad. Assessee is having two houses, one in New York, another one is Ahmedabad. Foreign houses are taxable only in two cases. Assessee's residential status is if ROR, the income from such property was received in India, either place of receipt in India or status is ROR. But here the assessee status is RNOR. But New York related house property related income, entire rent is received in India. Yes, one of the condition was satisfied. Therefore, foreign house will be taxable in India because the place of receipt located in India. Compulsory, you should calculate the income. The procedure for computation of income from foreign property is just same as the property if the property located in India. Foreign property, Indian property. The treatment is same. Okay. The one thing we should remember here is convert the foreign currency into Indian currency while calculating the income. That's the important observation. So anyway, here New York house will be taxable in India because the place of receipt from such income from such property was located in India. Ahmedabad house also taxable in India. And here one of the important point is New York house is let out property. But whereas Ahmedabad house is self-occupied property. NAV shall be taken as nil minus only one deduction, that is interest. For New York house, need to calculate GIV also. Deduct municipal taxes. After that, deduct section 24 deductions. For Ahmedabad house, the format is very simple. NAV shall be taken as nil minus only one deduction to be claimed. That is interest. Here, interest working note is very important for Ahmedabad. So, because pre-construction period interest also there involved in this problem. Calculate the PCPI plus current year interest and total, then claim maximum 2 lakhs because self-occupied property interest deduction is available only maximum up to 2 lakhs subject to some conditions, otherwise restricted to 30,000. I think here all the conditions were satisfied because the loan was borrowed on or after 1419. Ahmedabad was self-occupied. He had taken a loan 30 lakhs to construct the house on 1st September 2018. So, our conditions for claiming interest up to 2 lakhs for self-occupied are, first one is date of borrowing on or after 1499. Date of borrowing on or after 1499. Purpose of borrowing, either purchase or construction. Construction must be completed within 5 years. Please take, I think here all the conditions were satisfied. Therefore, you can claim 2 lakhs deduction as next. Question number 4. First one is Vishal had a house in Delhi is a clubbing provision. A clubbing related question. Vishal had a house in Delhi. During the financial year 22-23, he had transferred the said house to Miss Deepika, daughter of his brother, without any consideration. house would go back to Mr. Vishal after the lifetime of Deepika, but he transferred made with a condition that 10% of rental income from such house property shall be paid to Mrs. Vishal, Mr. Vishal, Mrs. Vishal, rent received by. So here the house property was transferred to Deepika subject to a condition that 10% of rental income from such property was paid to Mrs. Vishal. That's the condition. Whenever the agreement contains any condition, then such transfer becomes revocable transfer. Revocable transfer. Then section 61 gets attracted. Then the clubbing provision is the rental income received by transferee, that is Deepika, will be taxable in the hands of Mr. Vishal, transferor. Here the income will be taxable in the hands of transferor, will be eligible for clubbing in the hands of transferor. Okay, clubbing provision is there, section 61, revocable transfer of asset, because the transfer with a condition that 10% of rental income shall be payable to Mrs. Vishal. It's a condition. So that's why section 61 gets attracted, clubbing provision gets attracted. Next, Vishal holds the preference shares. He instructed the company pay a dividend of Mr. Chandni, daughter of his servant. The transfer is irrevocable for the lifetime of the Chandni. Dividends received by Chandni during the financial year. It's a clubbing provision. Section 60. Transfer of only income without transfer of asset. The income so transferred shall be eligible for clubbing in the hands of transferor. This amount also to be clubbed in the hands of transferor. Okay. This amount is also taxable in the hands of transferor. Here the transferor is Vishal, as per section 60, because he transferred only income without transfer of asset. Next, Vishal has a short-term capital loss 16,000 on sale of property and long-term capital gain 15,000 on sale of property. Says long-term capital gain, short-term capital loss. So short-term capital loss can be adjusted against long-term capital gain. Yes, set of facility is available. Therefore, it can be adjusted as long-term capital. Long-term capital gain 15,000 minus short-term capital loss 15,000. 0. Balance loss to be carried forward to subsequent year. Carry forward loss is equal to 1,000. Next, other incomes. Interest from savings bank account. Income from other sources. Plus 80 TTA deduction available. Next, cash gift 75,000 received from daughter of his sister on his birthday. It's a taxable income from other sources. It's received from relative, non-relative. It's received from non-relative. Therefore, taxable. Daughter of his sister is nothing but niece. Niece not covered in the definition of relative. Next, income from bettings. Taxable. Income from other sources. Income from card games. Income from other sources. Loss on maintenance of race horses. Carry forward to subsequent year, because it can be adjusted against same head of income, same nature of income. Okay. Point number B. Point number B is an internal choice. 4 marks, 4 marks. You can answer any of these two. It's an internal choice in 4th question, point number B. So it's a purely TD question. It's a loss return related. Loss return. 139 subsection 3. It's a purely TD question. And second one is PAN requirement. Quoting of PAN is mandatory or not in the following cases. First case, sale of scooter, not required, because so other than two-wheelers, whenever purchase or sale of other than two-wheelers, then PAN quoting is mandatory. But here two-wheelers, there is no requirement of quoting of PAN or purchase of two-wheeler, purchase or sale of two-wheelers, other than two-wheelers. Next, payment of life insurance premium 67,000. So payment of life insurance premium, purchase of flat 9 lakhs. Here is PAN requirement exceed 10 lakhs, either stamp duty value or actual consideration. Any one, if exceed 10 lakhs, then PAN quoting is mandatory. Okay, but here actual consideration is not exceed, 10 lakhs, but stamp duty value exceed 10 lakhs. Therefore, required to quote PAN number, mandatory. Okay. Any one of these two, either actual consideration or stamp duty value. If any one exceed 10 lakhs, then PAN quoting is mandatory. Next one, application for issue of credit card, PAN requirement is mandatory. Quoting of PAN is mandatory. So all these cases, quoting of PAN is mandatory except first one. Okay. All the best to all of you. Let's close here. Thank you.